Consideration of the March 31st, 2025 report of Lake County pooled investments, and we have the treasurer tax collector.
Thank you, Mr. Chairman. Thank you, members of the board. Thank you to the assessor's office and to your council. I appreciate it.
Thank you.
Thank you.
All right, it's treasurer tax collector.
Where are we at? Stop skipping. Wow, what's going on?
Can you add me?
You having issues again?
Yeah, it keeps skipping down to the bottom of the page.
Good morning. Patrick Sullivan, Treasurer Tax Collector. I've lost my voice. I'm just in the process of getting it back, so you may have to bear with me through this presentation. But fortunately, Carlos will be doing the majority of it, so you're in luck. So Carlos Oblitas is here from Chandler Asset Management. We're going to go over the Q3 report on investments. And, all right, it looks like I've been added as a panelist, so I'll put up the share screen momentarily here.
But it was Q2. Or Q3. Q3.
All right, I think we are up and running.
Good morning, supervisors. I want to talk a little bit about the past and also into the future. The past numbers, all good news. We've got very good news through today. Into the future, a little bit more uncertainty. I think that everybody knows that already. I just want to put some figures around it and some ideas. What I would tell you is that the environment that we operated under to be able to generate returns alongside with the county treasury has been an environment where the economy has been late stage in the business cycle and slowing down, but still exhibiting quite a bit of strength. Now, and the numbers that you're going to see are through the quarter end as stated in your packet, but we'll give you a little bit of a peek into the future numbers, and that's certainly because most of the activity in the capital markets have been tied to tariff activity that you're aware of and that you've seen in the news, and that will eventually have an impact on your earnings, and I do want to talk a little bit about that. I stated that the economy has been close to late stage, and I'm going to very briefly hit some numbers here. On page 4, you have the change in non-farm payrolls. It's just a measure of how many jobs we're generating. Generally, there's still strength in there. For the month of March, we generated 228,000 jobs, which is outstanding. Pre-pandemic, we were looking at 110,000 to absorb new entrants into the market. Through the April date, it was 177,000. The May numbers will come out this Friday. Waning, coming down, slowing down, but still exhibiting quite a bit of strength. It means that the businesses are still hiring people to be able to do, to expand their payroll, to be able to expand their business, and there's enough demand for their goods and services to be able to do that. The other figure that I want to touch on is inflation, which is when you have a lot of economic activity, you have growth in inflation. Inflation is just simply a rise in prices. It means that the dollars you have can buy you less, so they lose buying power. That number for the month of March was 2.8, which is considered a little bit elevated. For the month of April, that came in at 2.3. That's the chart on the left-hand side. It tells you that there is still enough strength in economic activity in the market to drive prices higher, and this is through the end of March. Certainly was before what you saw with tariffs. Through the end of April, tariffs hadn't really kicked in yet. And then when you want to look at what the consumer's doing, which drives a lot of the economy, on page number 7, we tend to look at retail sales. It's one of the first figures that comes in the beginning of the month, middle of the month. The March number came in at 1.4 month-over-month growth, which is considered decent. It's good. That was revised upwards in April to 1.7 for the March number, but the April number came in at only at 0.1, and you can see that that's already ratcheting back as consumers are tightening the belt because prices are going up partially as a result of tariffs. And then if we look at, flip forward to page, let's go to page number 11. I think that's important. So when we look at how the economy has grown, the economy over the last year, when I just take that bottom row that you're looking at there, those are the annualized quarterly numbers. So it's the growth during those 3 months, and then we give it to you on an annualized basis, the annual equivalent. When I average that out, that averages at about 2.5. So for calendar year 2024, we grew approximately 2.5%, which for the United States is considered decent. The first quarter number you don't have up there, but I'm going to give it to you. It was negative 0.3. It shrank. And most of that was driven by net exports. When you count how the economy grows in the United States, we look at 4 basic sectors. They are consumers, government spending, business investment, and then net exports. And the United States is a net importer nation, so that tends to be a drag number. That was reflective of businesses front-running tariffs. They were trying to get ahead of tariffs, and they increased their imports, which dragged down that number because they were trying to get a hold of goods and services, or goods, I should say, and material for their businesses before prices went up. They were trying to front run it. So we had a negative. The economy shrank last quarter is what I'm trying to say here. So why is this important? Well, it's important because if we go to the next page, the chart on the right-hand side, it's going to tell the Federal Reserve how to move that overnight lending rate between banks, which in turn impacts what you invest in. And if the economy is growing too quickly, they're going to raise that rate. And if the economy is slowing down, they're going to lower that rate. And if they lower that rate, eventually it spells lower earnings for you. For the last 3 meetings that they've had, they've paused. They've not moved that overnight lending rate between banks around. It's been at a range of 4.25 to 4.5. They've kept it there, but their bias is to start lowering it, which in the long run will mean lower earnings for you. When you look at the overall markets, and we turn to the final page, I want to look at the chart on the left-hand side. Those are yields for 2, 5, and 10-year treasuries. That's when you're lending the money to the United States government for a 2-year term, a 5 or a 10-year term. Well, back in March 31st, for 2 years, they paid you $388 per year. That number dropped to $360. It got cheaper. That was simply because there was a rally in the bond markets because people got nervous with the economy and with tariffs. The math works out that when people start buying up bonds, they drive the price up. That in turn pushes the yield down. I can get into the mathematics of it, but that's how it works. So it went from $388 to $360. It lowered. There was a perception that the economy would actually hit a wall faster than anybody anticipated as a result of tariffs. That's back up to $396 today. The 5-year was at $394, dropped as well, down to $373, popped back up to 4% today. And 10-year yields, which were at 4.25, 4.2, 4.21, those kind of stayed similar, and then they popped back up. Why are they popping back up? Well, partially it's because you've got a little bit of a rally in the stock markets, and investors are moving back to risk assets and out of less risky assets like bonds that you buy. But partially also is because there's a greater perceived there's a perception by investors that eventually the economy will not do very well, and the credit of the United States is just not going to be as good as it was in the past. Because of tariffs, investors are seeing the value of the dollar as a reserve currency diminish, and the purchase of the safety of U.S. Treasuries diminish vis-a-vis the past. It doesn't mean that they're dumping them. It just means that there's lots of questions as to what this is going to look like in the future. I will also note that Moody's, out of the 3 rating agencies that rate most bonds out there in the United States, they were the final agency that still held the United States Treasury at a AAA rating, the highest rating possible. Standard & Poor's downgraded the United States debt to AA, which is still very strong, but not AAA. They downgraded them a few years ago. Fitch followed through about 1.5 years, 2 years ago. Moody's in the past month did that, and they followed through. Now U.S. debt is now rated at AA+. So it's definitely rated lower. What does this all mean to you? Well, it means that you've had a lot of volatility in rates. Rates have moved up and down, and that can impact both your earnings, which hits your budget, because those are spendable dollars that you use to spend. Also, the Treasury handles money for school districts and other participants that are required to be in that Treasury. It means that the earnings are a little bit more volatile for them as well. It also means that the underlying value of the investments has moved up and down. Thus far, through the month of March, the returns were fantastic. The future earnings are still decent, but we anticipate that those earnings may be a little bit lower coming down the line. It will take you a little bit of time to reset into lower rates if lower rates do materialize. And that's simply because the strategy that you follow is a strategy where you maintain your investments on average at around 1.7, 1.8 years. It means that on average, it takes about 1.7, 1.8 years for the portfolio to turn over. It means that as rates fall, you are slower to reset and reinvest into those lower rates into the future than, say, the state pool, which is much lower. They're shorter. They're somewhere around 6 months. Those are the economics. I'm going to hit the numbers, and I'm almost there. I'm wrapped up because I know you have a busy schedule. Page 16, 17, and 18 is just a report on the compliance, whether your portfolio is in compliance with California government code and your investment policy. The answer is yes. Yes, it is. That's always a good thing to do. You were looking for yes and no answers. The answer is yes. If we look at page 19, I want to remind you that your entire investment program comprises 3 components. The first and largest component is the portfolio of securities that is actively managed by your investment advisor, Chandler Asset Management. The second component is a small seasonal liquidity portfolio. It was just a portfolio that we, in conjunction working with the treasurer tax collector, we identified an opportunity to invest very, very short-term cash at an advantage. That's that liquidity portfolio. That's been winding down because that advantage has been going away. We've been very, very tactical about that. And then the third component is the component that's managed in-house. That's using short-term liquidity pools to be able to make day-to-day cash needs available. So that component fluctuates because it includes a bank component, it includes funds in the state pool, it also includes funds in a local government investment pool. So those 3 components, that's what makes up on page 19 the $526 million through March 31st. You were earning a yield of 409. What that means is as of March 31st, if you looked into the future and nothing changed in this portfolio, your income would amount to 4.09% over the entire program. Through April, that went up to 4.2. And then the market yield was 4.17. The market yield is the yield you would earn on this portfolio had you purchased it on the date of this report. It infers a reinvestment. Think about it like this. If I receive new money, if the Treasury receives new money, they invest it to look like the entire program. They're going to average somewhere around 4.17. So it infers a reinvestment. It means the new money coming in, you're reinvesting at 4.17. Notice that 3 months prior, that was a 4.4. Rates have been dropping. They've been dropping already in the market. Through April, your yield to maturity of 409 was 4.2 I mentioned earlier. That reinvestment, 4.17, is down to 4.08.
It looks like the slide is older without the update.
Oh,
so
okay, yes.
The sweep is not imputed yet.
Okay, yeah, so we had an update to this slide, and I just gave you the updated numbers, which are better than what you're looking at there. In terms of the makeup of the portfolio, I think I want to go to page 27, and we're going to wrap it up with that. Sorry about that, page 23, and we're going to wrap it up with that. Sorry, I was looking for the makeup of the page 20, I apologize. We're going to wrap it up with that. This is what you're buying. These are the securities that you're buying. When you see the U.S. Treasury component on the far left-hand side of the chart, those are bonds of the United States Treasury. You're lending money to the U.S. government, and you're getting paid rent on that money. That amount makes up about 35% of the portfolio through March 31st. That has been the backbone of your investment program from a safety standpoint. I want to remind you that you have code-mandated objectives of safety, followed by liquidity, then followed by return. And you have to meet safety and liquidity first. You do that by investing in fixed income, debt-bearing securities. These are bonds. You're only allowed to buy these. Short-term, 5 years or shorter. And the sectors that you're allowed to purchase are limited. Treasuries are one of them, and they're still considered, despite all this business with tariffs, they're still considered the safest investments. The second largest component was corporate bonds, about almost 19%. And then you can see see all the rest. That cash component encompasses some of those monies that are in the cash sweep where you're earning funds from a money market mutual fund. So I would tell you this, from a past performance standpoint, you've done quite well. I ran some return numbers. These aren't yields. I just quoted you yields of what you're looking to earn if nothing changes into the future. That looks good. But if I do a look back through March 31st, the main portfolio, which is the only piece that I can really generate returns on, the main portfolio, well, you grew that portfolio through March 31st 5.56%. A portion of that, I'd say that about 4/5 of that was from interest income, because interest income is very strong. The remainder is because the value of the underlying securities went up in value. That doesn't hit budget, but it does hit your financial statements, which improves your financial position. And if I were to look at those numbers through April, that number became 6.61. You grew the portfolio for the prior 12 months, 6.61. And most of that, a big chunk of that, again, was from fair value appreciation. So you've done well. Going into the future, the concerns that we have, obviously, are the overall credit quality. The United States government is still considered a very safe credit and a very safe investment. That still will continue to be a large part of your investments. We are concerned about not just tariffs, but about what the impact of the tax bill. It has a name. The official name is Big Beautiful Bill. That's the actual official name. So that bill in its current format increases the deficit and increases the national debt, and investors are not. They're not digesting that very well. We think that will change in one form or another before it gets passed. But it definitely, it's seen as something that might drive credit into a little bit of a less stable environment. It's certainly being viewed by investors as something that might push us into a slowdown faster than anticipated. For you buy the safest of investments. That's by design. We continue to diversify those investments. We continue to diversify the maturities in those investments, and the returns have been good. We're just very vigilant as to what that might look like into the future. I'll stop there and take any questions you may have.
Supervisor Sabatier?
Yeah, just a brief question. Thank you so much for these reports. This is actually kind of the darkest of the reports that you've given
Sorry.
us, but still has some positivity points in there. I know I spoke to Mr. Sullivan about certain things. I'm really glad you hit on the Moody, because I had not asked about that credit downgrade. The policy that we put together, does it still give you the flexibility you need within the turbulence that we anticipate to potentially hit in the future, or do we need to at one point sit back down and review our investment policy that we originally did 2 years ago, something like that? Different economic platform to bounce off of. Just kind of wanted to check in and see, do you have the flexibility you need to keep us safe, liquid, and getting the revenues that we're looking for, or do we need at one point to sit back down and review it?
Supervisor Sabatier, the answer is yes. The policy continues to perform as anticipated. It encompasses the latest and greatest in code. Some of the most recent changes to code, which at some point we're going to want to come back and review, will not impact the way that we're managing the funds, and the policy continues to fulfill its role. At this stage, there are no changes needed in any of the provisions in the policy.
Okay. And then I know you mentioned LAIF being 6 months, seemed like we're invested about 0.8%, if I remember off the top of my head. It was a very small amount that we have in LAIF. But yet we're also looking to what we have a high percentage, I think it was 38% or 40% within the 6 to 12 month time frame for maturity on what we're going after in the bond market. Is there a reason we're not in LAIF? Is it less safe than in other places? Just curious.
I absolutely. I can give you the two-word answer, but I also want if your treasurer, because the treasurer tax collector controls that directly. We don't, but we discuss it. We advise on this. So when you're talking about local agency investment fund, LAIF, that pool is generally utilized by local governments in California for its most liquid investments. There are other options for your most liquid investments, primarily local government investment pools, LGIP. There's 3 of them in California. We're launching one We can talk more about that later. But basically, those are even shorter than LAIF. And LAIF is a very well-respected, well-run program. It's run from the State Treasurer's office. It's got a very good reputation, good staff. They're knowledgeable. Because of the nature of their cash flows and the way that they're structured, their yield right now has been lagging the yield of those local government investment pools, which are generally also well-run. There's also there's an inversion of the yield curve. That's a very technical term. It just means that there's a season right now where the shortest of investments, the shortest maturities, are paying you a higher yield than the longer maturities. It's a temporary thing, and it's been diminishing. Those local government investment pools, by their nature, because they're shorter, can take a little bit of advantage of that, and as a result, they're providing you a higher yield than what LAIF is providing you. That will eventually reverse. LAIF will actually outperform those. It's a timing issue, and right now the timing favors those shorter pools. I don't know if you'd like to add to that.
Yeah, that's actually the point that I was going to highlight, is that there is a time and a place where LAIF has been appropriate for us, and it very well may be that in the next year or so that we start using LAIF again in a way maybe not quite as heavily as we used it before, but it would certainly become part of our portfolio. What we do anticipate happening over the next several months, and I know Carlos already touched on it, was the uncertainty in some of the different federal policies and initiatives has led to concerns for us about predicting cash flow, what our needs are going to be, what the market's going to do. So we do anticipate changing our duration. We want to be more flexible. So I think a lot of our positions are going to go a little bit more liquid. We are going to take greater advantage of the local government investment pools, the LGIPs, which, for instance, we do plan, and your board will see an item in a few weeks. We are going to join with a few other counties to put another pool together. This allows a greater duration for us, more flexibility, sort of a better buying position than we can normally be in on our own. So I think that is one of our main strategies, where it's going to keep these funds liquid for us, but not as liquid as like our overnight money market at the bank. So we can get a better return than we can get at the bank, but I mean, not as great as we can get in some of the other securities. So it's trying to strike that balance. What may be valuable at this point is I do have the other graph that I could share with your board. And this may highlight some of the other things that are going on here. We've been sharing this each quarter. This is the quarterly earnings for the county treasury pool. And this is in actual dollars rather than percentage. So this quarter, or the quarter in question, ending March 31st, we did bring in just over $5 million. So you'll notice again, it has been that continued trend upwards. But as Carlos stated, we don't expect this trend to continue now. If anything, this is likely the peak of where we're at. I don't anticipate returns getting better than this. It should, in our estimation, begin leveling off. So if there's any questions about that chart, I'm happy to take them.
Can I add something? Completely agree with your treasurer tax collector. This may be the peak. It will likely level off. It will take some time for that to come down. No one is anticipating a return to the far left-hand side of that chart when rates were still zero. Right now, most investors and economists are anticipating that you may see lower rates over the next 24 months, but nothing to what we were living in pre and during the pandemic.
Supervisor Pyska?
Well, right, but pre and during the pandemic, we didn't have a
We weren't
portfolio.
investing.
So I think that's the biggest point of why it looks like that. But I just, I want to not take up too much time. I just want to thank you for bringing the more updated information, because when I was looking through this, I was like, oh, March, that's so long ago. So much has happened. So thank you for that. It is unfortunate because I think we were anticipating this to rise a little bit more. But this is where we are now today. And my other question was on increasing liquidity, but you've already answered that. So thank you, Carlos.
All right. Open it up to the public if there's anyone that would like to speak on this item. On Zoom? We have a hand in Zoom. Please unmute. No hands, okay. No hands in Zoom, bring it back to the board. This is a presentation. And we do have to, do we vote to accept it? Yes, so if there is a,
I move to accept the pooled investment report.
Second.
I have a motion and a second. All in favor?
Aye.
Any opposed? Motion carries. All right, thank you very much, Carlos.
Thank you.
Thank you.